In this week's update, is this really an AI bubble? Where to for gold and silver from here? And are you focused on the right things? My name is Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. There's been a lot of talk in recent weeks, and particularly at the moment, about whether AI is in a bubble and the market's reached the top and it's going to crash. So I thought I would address that issue together with the possible correction in precious metals as well. From my perspective, the environment now in 2025 is just so different to when we had the last major crashes in 2000 and 2008. In those two instances, we had a pretty poor regulatory environment for investors that really encouraged and enshrined bad behaviours on all parts, not only the organisations that were selling the services and the concepts, but also by investors as well. So we're in a very, very different environment these days. And back then, neither period produced something that was real or useful, and a crash was required to clean out the excess. So I see this as being a totally different period altogether. And so just a simple evaluation that valuations might have run too far too fast is just not the right way to look at this. These days, AI is providing real solutions and tangible benefits. There's no question about that. They're producing, particularly for the major companies, cash flows and profits. Whereas back in 2000 and 2008, that was definitely not the case. And valuations, most importantly, valuations are underpinned by earnings per share growth. Whereas if you think back, if you were in the market at that time, you think back to 2000 or 2008, they definitely were not being underpinned by valuations. They were just completely off the planet. So a totally different environment these days. And if you look at the term bubble, I really have the same problem with that term that I do with the term blue chip. A lot of the top 100 stocks in Australia that are considered as blue chips are some of the most dangerous and wealth-destroying stocks on the market. So that term blue chip, I think, is completely useless. It's a waste of time. And I think the term bubble is as well, because what does that really mean? Just because you've got a strong trend doesn't mean that you've automatically got a bubble. That's just crazy. Corrections are normal. They're a normal part of the process. The market advances quickly. It gets ahead of itself, gets ahead of valuations, and we get some sort of correction, which might become large enough to be called a crash. But it's just part of the normal 3 steps forward, 2 steps back kind of process. And it's actually necessary to prevent extremes of valuation and excess. It's a chance, and this is the most important thing, it's a chance to reset on better terms. And that's why if we do get, or when we do get some sort of top in the market, that you see that not as a problem, but you see it as an opportunity to reset on better terms. So it gets down to, what does your exit strategy look like? If you don't have an exit strategy and you get out too late, then yes, that's a problem. But if you've got a good, solid, repeatable exit process, then you don't get out at the top, you get out some short time after that, and then that provides the cash to reset at better values. So it's not something to be feared. That's the point that I want to make here. So the solution is, and this is what I've been talking about most weeks for years and years and years, we do 2 things. We do a fundamental evaluation, and you've got to remember that the backdrop to AI, this is a century level dimension kind of new technology that is going to provide consistent, strong tailwinds. This is like the Industrial Revolution. So this is a major change in technologies and the way that we live. So when you've got that sort of backdrop, then you can't use the normal, more minor situation yardsticks for valuation. Now, as you would know, my approach has been that I only focus on the right sort of stocks. I don't look at the whole market. I don't try to evaluate the whole market. I only fish in what I would regard as a pretty productive pond, and that is stocks that have a high probability of sustaining elevated long-term growth. That's all I look at. If the stocks do not have those characteristics, then they don't even get researched. So from a fundamental point of view, narrow your focus because there's still plenty of them. Narrow your focus and only fish in a productive pond. And then once you've done that, it then becomes the most important element, and that is the technical evaluation. Money flows tell you what is happening in the market. And you need to resist the urge to try and predict what will happen or to anticipate what will happen, because it somehow feels better. It makes us feel like we have more control over the market if we can somehow predict or anticipate what the future might hold. The truth is that that's actually a negative step. You're doing yourself a disservice if you think that that is going to help, because what it does, it tends to bake in the wrong sort of conclusions. So forget all that, and we just look at where the money flows are going, whether the sellers are in control or the buyers are in control, and we enter when the odds are in our favor. We wait according to a predetermined plan. So what percentage of your portfolio is going into certain different stocks. And then we exit when the money flows reverse in a time frame that's connected to your purpose. Now, if you're a long-term investor and we get an exit signal based on very short-term price action, then that's not relevant to exit because it's not relevant to the time frame over which you're investing. But if you're a shorter-term trader, then obviously it is more appropriate. So there is no one-size-fits-all kind of exit strategy. The way to do it is to look at what the money flows are telling you and look at if that is relevant to the timeframes that you're operating in and the purpose that you're operating in. So what do you need to be able to do that? Well, obviously you need the skills to be able to do both fundamental analysis and technical analysis. And it's so important with fundamental analysis to be able to put into context what it is that you're actually analyzing, because companies can do things for a period of 6 months or 12 months where they're setting themselves up for the next phase. And so the growth might slow or some other financial metric might look as though it's changed, but you've got to look at what is the company trying to do here? How good is the management team and what is their track record in being able to make these significant changes to the business direction? So you've got to be able to put things in context. The next thing is you need the time and the passion to execute this consistently. And it does require a bit of time. If you want to do all this yourself, then you need to be thinking about at least a few hours a day of concerted research and ongoing monitoring so that you don't miss opportunities. You've got to have an organized system. And for most people, they don't have the time or the inclination to want to do that. So the important thing is, if that is where you're at, and that's, I guess, most of the investing population just doesn't have the time, the skill or the interest to do it, then you need to be prepared to buy in that required expertise and focus. It's just the way it is. Now, as always, every week, we strongly advise not to take any action just on what's in this video, but to seek whatever other investment or legal advice that you might require. Now, I thought I'd just mix the order up this week because precious metals is such an important part of what's going on, and it was a bit of a roller coaster week for gold and silver. As everyone knows, we've had an incredibly strong run in gold, but this week we were down $142 to 41.08, 3.35% down. So it was a bit abrupt, but it's not the end of the world, as you will see. Translated into Australian dollars, that was still just over 6,300. So this is still incredibly profitable territory. Yet we saw Australian gold stocks, Australian gold producers selling off sharply. Plenty of 8 to 10 to 12% down sessions during the week. So that sounds like an opportunity to me when we've still got the Australian dollar trading at these levels, which are incredibly profitable. Australian gold stocks represent very good value. And I'm sure that in this next little phase, we are going to see some overcorrection of share prices, and we will see some terrific opportunities unfold. Now, silver didn't miss out either. It was down by almost double, which is normal, down to just under $52. So a pretty significant correction in silver as well. But what I want to do, again, to put things in perspective, which is so important, you can't just take the surface level numbers and draw conclusions from that. You need to put it in perspective. So here's a perspective that I think is really valid. So looking at gold over the last 50, 60 years to get a sense of, is this likely to be a significant top like we saw here in 1980, like we saw here in 2011, that's going to lead to perhaps 5, 10, or even 20 years of underperformance. So going back to the late 60s, you can see the advance that we had from, I've just put some percentage advances here, from the low for gold to the next significant peak was a 550% gain. If we look at the next run, it was a 506% gain to this peak in 1980. We then had a very, very long period until we got to 2001 when the gold market started to really take off again, and we got a 633% run. So they're all very, very significant long-term runs, and this one lasted for 10 years. And it's a bit arguable which point you take as your starting point. I could take this one here, which would add some significance to this percentage, but I think this is really the more relevant one because this is where gold actually broke out of this long-term consolidation between 2011 and where we've taken off recently, breaking out of that consolidation. So that's September of 2022. So this has really only been going for around about 3 years, and it's only advanced 273%. Now, that in its own does not guarantee that this is going to continue for a decade or it's going to go up 5 or 6 or 800%. However, when you combine that with what we're seeing at the moment, the very significant shift in some of the long-term fundamentals, the fact that many countries are now actively seeking to move away from US treasuries into something else, and one of those something else's is gold. There's this US dollar debasement trade going on, and that is a very significant change that's really only emerged in the last few years. So I look at this and ask myself the question, put it in perspective, is there any reason why gold cannot double the gain from here, go up 500, 600%, and do it over the next 5 to 10 years? And the answer I have to get is there is absolutely no reason. In fact, there is more reason why gold would go up than for this to be the top. So for me, until proven otherwise, you stay with what is. And what is we've got an enormously strong trend. Yes, it got a bit ahead of itself, but now it's correcting back. This is normal, it's natural. And I think where we're standing right now, at some stage in the next few days, few weeks, or possibly even few months, we're going to get a magnificent buying opportunity again for gold stocks. So that's where I see the gold market at this point in time. When we look at stocks themselves, it's most likely that we're going to get just some sort of consolidation rather than a significant correction. And who knows, we could even be there. The bit of a clean out that we had in the week just gone, that could be it. Or we could get a bit more downside. But again, this is where you need to have a pretty clear game plan about how and when you enter. What do the chart patterns look like that give you higher probability? Now, the GDX listed on the Australian Stock Exchange was down 14.4%. Gold was down 3.35%. That seems like a bit of an overreaction to me. Now, some would argue that, okay, gold stocks had run too far. That might be the case. I don't think about it too much. I just look at the individual stocks. I look at the chart patterns and I look at what that tells me about the buying and selling pressure, who's in control. So I think there's an opportunity in the real standout stocks, whether they be standout producers or whether they be standout developers. And in the Australian market, you've got hundreds and hundreds to choose from. So how do you make that selection? What is it that makes a standout stock, whether it be a producer or a developer? And again, I've spoken about this on numerous occasions in the Sunday video. I'm not going to do it again here now, but this is a constant topic of discussion with our memberships. What you need is an orderly, repeatable selection process, and you need a sharp perspective on what it is you're doing, the ability to be able to put things into context and clarity about your process. So this is the Aussie index on a weekly chart, and you can see we really started the run in late December, so effectively it started at the start of 2025, and it's been an enormously strong run. And the week before last, the week ending the 17th of October, was the strongest week of all. So that was the final very significant blow off in gold stock valuations for the time being. And so it was natural for the rest then to get a correction week. We're miles and miles above the 8-week moving average. So this week just had to happen. It's good, it's healthy, and that's how you should see it. Now, are we at the bottom, or are we going to come back down? Let's say we're going to come back to a level perhaps down here. I don't really know. I know what it looks like when the market bottoms out and turns up. So that's all that I'm looking for at this point in time. But I'm also aware that this also could be the low point was formed last week. So I'm just on alert. I've got my targets well and truly prepared. I know exactly what I want to buy, and I'm just tracking those stocks. If we look at GDXJ, which is listed in the States, a very similar situation there. So that's the precious metals market. I'm very excited by the opportunity that we're now going to get there. So now turning to American stocks, the S&P still did very well, ended up rising 1.9% for the week with a very strong finish. The NASDAQ up by 2.3%, and the Russell 2000 was up even more by 2.5%. And that tells you that this is not a gain that is driven just by the Magnificent Seven or a handful of large cap stocks. This is quite broadly based, where the small caps are actually advancing more quickly. The US dollar index was at 98.94. The 10-year yield was steady, 4.02, and the VIX dropped from, I think we were around 2021 last week, and that dropped down to 16. Let's take a quick look at the US charts. We'll start with the NASDAQ composite. On a daily chart, you can see to finish the week, we had a gap up and a strong finish near the highs. So this, again, another set of new all-time highs. So that's the NASDAQ. Not a lot else needs commenting on that. The trend is being sustained. You can see that the 8-day and the 20-day moving average, which is the orange and the green, are still basically lined up in the right order. The price is above both of them. And so this simply remains a very strong trend, and the money flows are supporting that. Look at SMH. So this is the semiconductor index, which is so important to look at for the overall health of the market and telling you where the money flows are going. And you can see that again on a weekly chart was another very strong week. It was neither weaker or stronger than what has just preceded it. It's just progressing in a very nice, orderly manner. We look at the relative comparisons. XLV and XLK still lead the way there. Really no change at all where the money flows are going in the US market. And we did see a bit of a surge in materials, came off towards the end of the week, but materials and small caps remain the leaders in the Australian market over the last month, and then a bit of a gap down to the finance sector. So that's the US and Australian markets. So just to confirm, our dollar finished at 64.5, and there was really no material change there. Our index gained 0.25% for the week, but the odds are we'll get a pretty buoyant start on Monday. And energy was positive with a rebound in the crude oil prices, but that was offset by some weakness at the end of the week by materials. So wrapping things up, this is a bit of a shorter video this week. I'm just in transit, but those couple of really important things I wanted to comment on. One was the supposed AI bubble, which in my view is not, and also the position around precious metals and how you should be thinking about the precious metals market. So the final message this week, to me, the biggest risk about AI is not that it won't be an incredible catalyst for extraordinary profits and cash flows in the future. Yes, we're going through a period where companies are still building that up, and there's plenty of commentary about how AI is not producing the sort of benefits that everyone thought, the profits that everyone thought. But, give it a chance. We're probably only in the first innings here, and there's a long, long way to go. So keep an open mind on that score. And it's not a bubble if the earnings justify the valuations. And whilst we will always get some short-term excess, stock prices always get ahead of themselves. Investors get too enthusiastic. There's too much leverage in the system. But that doesn't mean that we're in a bubble. That just means that we've advanced in the shorter term too far, too fast, and we need a bit of a correction. And that's just how markets are. They get ahead of themselves from time to time. But that is easily solved. If you think that's a problem, it is easily solved if you've got a very clear technical game plan, if you know what entries look like. Now, if you don't have a clear technical game plan, then you need someone who can give you some guidance on that, either to teach you or to just basically provide the recommendations. So the market is constantly presenting opportunities, and that's how you need to think about it. The question is, are you ready to accept them, or are you going to get caught up in the media narrative about AI bubbles and the gold rally has finished and all those sort of media things that can throw you offline? Portfolio Analyst last week was about identifying changes of character. So it was just what I've been talking about, the ability to look at a price chart and understand what is a real change in selling control, buying and selling control. And we'll continue to do that most weeks. And the other topic that we also looked at was hedging with reverse ETFs for those that, perhaps are nervous that we're getting close to a point of a more significant correction. So that was Portfolio Analyst last week. There's a $1 trial for 2 weeks for anyone that hasn't tried Portfolio Analyst. I think you'll get a lot out of it, even if you only stay for the trial period. So that's it from me for this week. We've got some of the world's biggest companies reporting this week. That certainly will have an influence on the short-term direction. So I think this will be a pretty pivotal week in the US market, and therefore, hence, for all other markets as well. Some more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.